go to the next one, joint venture purchase. JV is one of the ways to overcome the 90%. JV is joint venture. You hear a lot JV, right? Joint venture. So what is the loose JV? Loose JV means, simple words, handshake, done. Today buy together, share the loan together, everything. Okay? And you can open a trustee deed. There is a JV agreement. But remember this JV agreement, if you go auction, the bank win, it's not valid. Okay? So you can form a sembilan berhad. This one is a IHC actually. You can JV with anybody you want actually. Here, anybody. But remember the bank has final say because the charge in legal charge always win. The charge is the highest. Charge if it's title, PA, power of attorney if it's no title. You all know what is this document? Okay, good. So both JV partners very important. You must have same vision and goal. Don't like one want to sell, then the other one don't want to sell, then you have a problem. IHC. So what is an IHC? IHC means investment holding company. It's a sembilan berhad lah. Okay, with 80% of the incomes is derived from activities from rental, dividend, and interest. Meaning this company is like a shell company where you put your income inside. It can be used to borrow loans and pay taxes. And I've seen some IHC who has been around for a long time. They themselves generate their own income because throughout the years, they inject the asset inside, more and more asset. As the founder get older, they inject more and more asset. Then this IHC generate their own income. They can use to borrow loan, no problem. And it functions just like operating company, property management, no problem. Okay, you got risk management. If you joint venture to buy a 5 million shop lot, for example, and then you put 5 names on the S&P, it's harder for you to sell because all 5 need to agree. You want to sell the property, all 5 need to agree, sign. But let's just say if you divide them into, put it in a company and 5 of them, the person that come out, the biggest capital has the most share, then you wouldn't have this problem. It's easier if you want to sell a property, you just sell the whole company. Okay? That's why risk management. Greater finances, you can apply loan immediately. IHC can apply loan immediately. Because the guarantor, the income they derive is not from the company itself, company no income. So it's either from a corporate guarantee or an individual itself. Okay, this one, reduce risk exposure. Depends because some of the banks, right, they will want to know the individual guarantor, the commitment, so they will take into account the securities commitment. Most of the banks actually do it at this moment. Reduce here meaning that, for example, let's just say you buy under you refinance to IHC, then your individual name you can buy somewhere. That's what it means. Tax. You got a tax benefit, less than 5% of gross income, you are permitted expenses, director fee, management fee, whatever fee. That's why the rich get richer. Once you all got the more bigger and bigger portfolio, you need to look at you need to be friends with your accountant, find an accountant. Okay? Because the rich pay tax lesser than us. Legacy, like I mentioned, where my customer is getting older, right? So he transfer a lot of his asset to the company, and then at the same time he reduce his shareholding amount, go to his children as he get older. That's legacy. Easier to transfer than, okay, you get 1.5 shop lot, cannot, or half shop lot, at least cannot. Okay, these are the IHCs you follow here. Residential is always 60. Bank negara guideline always 60. Commercial can be 80 up to 85. On top of that, what is good about buying with company is that you get a working capital on top. Working capital means like a personal loan, but it's a collateral as a property. It can be very high. It can be up to about 60% of the revenue or 20% of the property price. So for example, let's just say you buy a shop lot worth 1 million. I give you an $850,000 loan, and another on top of that, 200,000 working capital. That 200,000 is a different account. It's like a personal loan. Consider a business loan, okay? Then if it's more than 30%, then it's worth it for you to transfer, not no. Okay, these are the management fees that you need to get. 4,000 and 6,000 per year. You have to pay auditor fees, secretary fees. Annual company or account must be audited. These are all the expenses you need to give. So remember, if your properties that you have now does not exceed 4,000 a year, don't send out IC, you'll be wasting money. Please buy under your individual name, continue. This one, can you do this? Refinance your property. Okay, property now, S&P and loan is to refinance the property to IC without changing S&P ownership. Can you do this? That means I give you an example. That means now individually, loan individual, S&P also individual. But now the loan only I want to transfer to IC. The S&P still remain individual. Can I do that? Yes, can. It's called a third-party financing. Because remember, IC are Sembilan Berhad, and Sembilan Berhad is another legal entity. They will treat this as another person. So can, but not many banks can do. Very rare. When is a good time to transfer? Just not the answer. More than 30%. Any other questions later? Okay. Debt service ratio. This is for individual. For companies, we call it debt service coverage ratio. How it count? Very complicated. But you have to send. What you can do is to send your audited account 3 years to the banker. Then the banker will be able to count for you. Asset has to be more than liabilities, of course. It goes without saying. Hi everyone, this is Kenny here. Thanks for watching. If you enjoyed that clip and you have benefited from it, please hit the subscribe button and hit the like button for the YouTube algorithm. Also, if you are watching this on my Facebook page, hit the like button and also share this video wherever you are watching. Thank you so much, and I hope to see you again in the next video. This is Kenny here from Problem Solving. Bye bye.